Looking to 2025, we believe the real estate market has turned a corner. Our recent global survey indicates a shift in sentiment. We saw the most positive results from that survey since February 2022, with the majority of respondents expecting real estate market conditions to improve over the next 6 months. Now, that's not to say 2025 will be an easy year. Conditions vary widely between markets and sectors, and in some cases within markets and within sectors. The continued recovery will be accompanied by continued high levels of uncertainty, given policy unpredictability, financial market volatility, and geopolitical risks. Steady economic growth expectations combined with easing monetary policies are likely to provide further support for financing and investment transactions and boost M&A activity in the year ahead. Institutional investors have been more active in late 2024. As borrowing costs and property values stabilize, we expect liquidity to continue to improve in 2025. Additionally, private investors are also likely to remain more active in this next cycle, with rising allocations to commercial real estate. The window for early movers in this real estate investment cycle is open, but how long that advantage lasts, especially in some favored sectors, will depend on the pace at which the new liquidity cycle matures. Yield compression has already been evident across in-favored sectors such as living, logistics, and select alternative asset classes, one noteworthy example being data centers. We expect investors' shift toward these sectors to continue in 2025. Pro-industrial policies, supply chain shifts, and nearshoring will boost momentum in logistics and industrial, particularly in the US, driving tenant demand. Within the living sector, demand remains generally strong and investment transaction momentum is building in the US, UK, Germany, and Japan, with conviction also growing in less mature segments around the world like build-to-rent and student housing. Globally, JLL expects $1.4 trillion to be deployed into core living strategies over the next 5 years. Investment in data centers has been concentrated in the US, which accounts for 58% of global market share in the last 5 years. But there is growing demand for data centers in Europe and Asia Pacific as well. In the office sector, demand, supply, and investment interests remain relatively strong in many Asian markets, while many occupiers in Europe and North America will face a surprising shortage of top-quality space given the dramatic decline in office construction and the structural challenges in the lower end of the quality spectrum for offices. Overall, we think opportunities will be plentiful in 2025, but given the combination and the interplay of recovery and risk factors, we also believe that understanding the nuances of market dynamics at both the macro and the micro level will be particularly important for investors, developers, and corporate occupiers to successfully navigate the year ahead. We look forward to that journey with you.
Our Global Future of Work survey indicates that many companies are pivoting back to growth over the next 5 years. And in 2025, we're expecting across property types, real estate demand to be broadly stable or increasing. This means that we're going to be seeing greater competition for in-demand buildings and locations. New construction has fallen over the last 12 months, and that means that in places where occupiers are looking to move and where new buildings are more scarce, then there's going to be greater competition. In the office sector, that includes cities like London and Madrid in Europe, Chicago, Boston and New York in the US, or Seoul and Tokyo in Asia Pacific. At the same time, older buildings and space in non-central locations will be at greater risk of obsolescence, and we're going to see a need for more refurbishments and expenditure to bring those buildings up to standard and ensure they remain viable. We're seeing the same general trend of more limited supply across other property types in 2025 as well. Higher construction costs, labour force constraints, more expensive financing, all mean that new construction has fallen across many countries and property types over the last 12 months from their previous peak levels. And so that's going to keep prime buildings in more limited supply in 2025. The exception to this is data centres, where we're expecting to see the available supply increase by 20% over the year. But even that won't be enough to keep up with the huge levels of demand we're seeing in the sector, and so that will keep the amount of space that occupiers can access limited through the year.
So we're seeing a significant evolution in workplace policies. Recent announcements from high-profile global businesses indicate a trend towards mandating increased office presence, with some requiring up to 5 days a week and implementing attendance tracking measures. But this isn't the right approach for all organizations. Much of it really depends on the culture and the leadership style of the company. We predict that office attendance policies will settle into an average of 4 days per week, and this approach balances the benefits of in-person collaboration with the flexibility that many employees have come to value. Organizations will need to carefully calibrate their policies to meet those business needs and also the employee expectations in this new landscape. So despite the prevalence of hybrid work models, our research indicates that a surprising trend in corporate real estate portfolios is upon us. According to our Future of Work survey, 64% of respondents anticipate company headcount growth by 2030, and 53% expect an increase in their total footprint during the same period. This growth is particularly noteworthy given the context of hybrid work arrangements, or what we like to call dynamic occupancy. We anticipate that dynamic occupancy will drive greater efficiency and portfolio optimization, but portfolios will continue to grow. This contradictory trend reflects the complex interplay between flexible work arrangements and the need for collaborative spaces. The specifics of this growth are likely to vary based on factors such as geography, industry, or organization size. CBD locations will remain highly desirable, with 56% of organizations we surveyed said that they plan to increase investment in these areas by 2030. There's going to be a strong emphasis on quality space as well, with companies saying that they're willing to pay a premium to occupy buildings with leading sustainability and green credentials. This aligns with growing corporate commitments to environmental responsibility and employee well-being. The focus on human experience will be paramount, with organizations aiming to create destination workplaces that attract and retain talent.
While regulatory compliance and net zero carbon commitments will remain key drivers, decarbonization efforts are increasingly being integrated into broader real estate strategies as a form of achieving operational excellence. This is because at this point in the energy transition, the capital invested in reducing emissions in buildings will result in lower utility costs, secure energy, regulatory resilience, and improved employee attraction. This evolution is transforming the concept of decarbonization from being solely an ESG consideration to becoming a critical component of risk management, as well as a strategic economic opportunity to create value through optimized building operations. So energy use is the single largest operating expense in office buildings, usually representing about 1/3 of operating costs. Light to medium energy retrofits can deliver between 10 to 40% in energy savings. So for office properties, our research shows that light retrofits typically result in $4 to $5 per square meter in energy savings, while a medium retrofit on mechanical, electrical, and plumbing or MEP equipment can deliver roughly $17 per square meter in savings, and even further savings are possible with the help of AI-powered technology to continuously optimize building performance. Savings vary across asset types given different energy intensities of operations and uses, as well as varying energy prices by market. Because sectors like healthcare, labs, and data centers tend to be 2 to 5 times more energy intensive than office, the potential for cost savings from optimizing energy use are significantly greater for those asset types. We found that savings from a medium or MEP retrofit can be around $50 per square meter for labs, and healthcare facilities compared to $17 for office, and as much as $118 per square meter for data centers.